Hi guys, this is cabalakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. In the today's class, we will be revising group audits. Basically, in this group audits, we will be having audit of consolidated financial statements as well as SS 600 using the work of another auditor. These two concepts together, they are covered in group audits in new syllabus. Okay. Now, firstly, we will see audit of consolidated financial statements. What are these consolidated financial statements? Generally, as per section number 129, subsection 3 of Companies Act 2013, if a company is having subsidiaries, associates, and joint ventures, then the company, in addition to its standalone financial statements, it should also prepare consolidated financial statements. And in this consolidated financial statements, the standalone financial statements of parent, subsidiary, and associates, joint ventures, all these they will be clubbed to prepare these consolidated financial statements. Hope that is clear. So Companies Act imposes requirement on the companies to prepare consolidated financial statements. Just a second. Yeah. So Companies Act imposes requirement for preparation of consolidated financial statements, and the provisions that are applicable for preparation of standalone financial statements shall be mutatis mutandis applicable even for the preparation of consolidated financial statements. If you have prepared standalone financial statements as per accounting standards, then the same accounting standards you should also apply for preparation of consolidated financial statements. And the accounting policies, all the accounting policies that you have applied, all the provisions that you have applied for preparation of standalone financial statements, the same they will be mutatis mutandis applicable even for the preparation of consolidated financial statements. Okay. Next, as per Companies Act, certain companies they need not prepare consolidated financial statements even though they are having subsidiaries, joint venture, associates. What are those exceptions? In order to avail this exemption, a company needs to satisfy three conditions. If the if these three conditions are satisfied, then that company is exempted from preparation of consolidated financial statements as per Companies Act. What are those conditions? First of all, the company should be either wholly owned subsidiary or partly owned subsidiary of another company, and it has informed to all its shareholders that it is not going to prepare consolidated financial statements, and the shareholders they have not objected for the company's decision of not preparing consolidated financial statements, and the company is having proof of such communication to the shareholders. This is the first condition which has to be satisfied. Sorry. And moving to the second condition, apart from this second condition, this company, it should not be either a listed company nor it is in the process of listing. Okay. This second condition should also be satisfied. And the third condition, its ultimate subsidiary, its ultimate holding company should prepare consolidated financial statements. If these three conditions are satisfied, then that particular company is exempted from preparation of consolidated financial statements. Let's say there is A Limited. Now A Limited is having B Limited as subsidiary, and B Limited is having C Limited, D Limited, E Limited as subsidiaries. Now, if you see as per 129 subsection 3, B Limited has to prepare consolidated financial statements because it is having subsidiaries. But if B Limited wanted to take the exemption, it needs to satisfy three conditions. What are those three conditions? First of all, B Limited should be either wholly owned subsidiary or partly owned subsidiary of another holding company. Here, the first condition is satisfied because A Limited is holding B Limited. and B Limited should inform to its shareholders that it is not going to prepare consolidated financial statements, and shareholders should not have any objection for the decision of the B Limited. Let's say it has intimated to shareholders and shareholders have no objection. Okay. And B Limited, let's say it is not a listed entity or it is not in the process of listing also. So second condition is also satisfied. And in this situation, A Limited is preparing consolidated financial statements. Since third condition, all the three conditions are satisfied, now B Limited, it can avail exemption from preparation of consolidated financial statements as per Companies Act 2013. In the same way, there are also certain exemptions that have been provided as per Ind AS as well as AS. If you see, Accounting Standard 21 deals with consolidated financial statements. Now, as per Accounting Standard 21, a company need not consolidate the financials of a subsidiary or associate if the intention of the company is to hold them on a temporary basis. Okay, if the intention to hold the shares in such subsidiary or associate is in the nature of temporary control, then such a subsidiary need not be included into the consolidated financial statements of the company. And also, if there are severe long term fund transfer restriction, okay, fund transfer restriction means in some situations funds cannot be transferred from subsidiary company to holding company because of certain law or regulation. There will be certain restriction of up to some 10 years or 15 years from transferring funds from subsidiary to holding company. Now in this situation, there is a severe long term restriction on transferring funds from subsidiary to holding company. If in these types of situation also, the holding company, it need not consolidate, it need not include the financials of such subsidiary into the consolidated financial statements of the company. Okay, these are the two exceptions available as per Accounting Standard 21. However, the same exceptions, they are not available in Ind AS. If you see, Ind AS 110 deals with consolidated financial statements. As per Ind AS 110, if an entity is an investment entity, then such entity need not prepare consolidated financial statements. See, investment entity measuring subsidiaries at fair value through profit and loss account need not prepare consolidated financial statements. Now, the question that arises is, what is an investment entity? In order to call a particular company as an investment entity, first of all, it should be providing investment management services to its customers by collecting the funds from the customers and managing the funds on behalf of customer. And the company should be investing, the company should be doing business for earning either capital gain or income in the form of interest or dividend. We call it as investment income. These two should be the major incomes of the company in order to call a particular company as a investment company, and it measures its investment on a fair value basis. If these three conditions are satisfied, then you can call that particular company as an investment company. And the investment company, it need not prepare consolidated financial statements as per Ind AS. Now the question that arises is whether the exemptions as per Companies Act, Accounting Standards, Ind AS, whether all these exemptions can be utilized. Yes. Okay, if a company is falling, or if the company is satisfying conditions as per Companies Act, and it is eligible for exemption from preparation of consolidated financial statements, it can take the exemption. It is not satisfying the conditions of that Companies Act, but it is satisfying these conditions: temporary control or severe long term fund transfer restriction. Here also you need to observe one thing. Here, as per Companies Act or as per Ind AS, the exemption is that the company in entirety, it need not prepare consolidated financial statements. Okay, there is a B Limited. If B Limited satisfies conditions of Companies Act, or if B Limited is an investment entity, then this B Limited, it need not prepare consolidated financial statements at all. But if you see the exemption under Accounting Standard, it says that if there is a B Limited and B Limited is having temporary control over C Limited, but it apart from C Limited, B Limited is also holding D Limited, E Limited. Now the control over D Limited and E Limited is not temporary; they are permanent control. Only control over C Limited is temporary control. In that situation, only C Limited need not be included in the consolidated financial statements. D Limited and E Limited should be included into the consolidated financial statements, and B Limited should prepare consolidated financial statements. Here the exemption is only from inclusion of such a subsidiary on which the control is temporary into the consolidated financial statements. Hope that is clear. That is the difference between the exemption as per accounting standards and exemption as per Ind AS or the Companies Act. Hope you are clear with these exemptions. And the definition of investment entity. Next, parents' responsibility for preparation of consolidated financial statements. Yes, obviously the parent entity, it should prepare the consolidated financial statements. For the purpose of preparation of consolidated financial statements, it needs to identify the components. Components means all the subsidiaries, associates, joint ventures, all these will be known as components. So which components has to be included into the consolidated financial statements? For this purpose, first of all, components has to be identified. Once the components has been identified, you need to obtain accurate financial information from such components for the purpose of inclusion into the consolidated financial statements. And also parent entity needs to identify reportable segments for the purpose of segment reporting. Okay, even in the consolidated financial statements also segment reporting must be done. And also parent entity should identify related parties and related party transactions. Even this related party transaction should be disclosed or presented in the consolidated financial statement. So identify related party transactions, and then it is a responsibility of the parent entity to make proper consolidation adjustments. We will be discussing there will be two types of consolidation adjustments. One is a permanent consolidation adjustment and another one is a current period consolidation adjustment. Okay, like this there will be two types of consolidation adjustments. And then harmonization of accounting policies and accounting framework. If the parent is following a different accounting policy and subsidiary is following a different accounting policy, for the purpose of preparing consolidated financial statements, you need to harmonize the accounting policies that are being followed by these two. Okay, in the consolidated financial statements you need to follow the accounting policy that is being used by the parent entity. Hope that is clear. Next, gap conversion. Let's say the company is having a foreign subsidiary. Now foreign subsidiary, they will prepare their financial statements as per their local gap, generally accepted accounting principles. Okay, as per their local gap they will prepare financial statements. Now for the purpose of consolidating them with the parent entity, you need to convert those local gap financial statements into the financial statements by following the generally accepted accounting principles that is being used by the parent entity in India. So such gap conversion should also be done by parent entity. All these are the responsibilities of parent entity with respect to consolidated financial statements. Next, what are the responsibilities of the auditor with respect to consolidated financial statements? First of all, auditor needs to verify whether these consolidated financial statements have been prepared as per applicable financial reporting framework, and also whether these consolidated financial statements are showing true and fair view or not. And auditor needs to inquire into the matters required as per section number 143 subsection 1 of the Companies Act 2013. And along with that, auditor should also report on matters that have to be reported as per section number 143 subsection 3 of the Companies Act 2013. We have discussed 143 subsection 1 and 143 subsection 3 in the reporting chapter, if you remember. And the auditor, he should also validate whether this entity is actually required to prepare consolidated financial statements or not, whether it is falling under the exemption criteria. This needs to be verified. Next, just a second. Next, considerations regarding materiality during the audit of consolidated financial statements. Auditor, he needs to calculate the materiality at the group level, and he should also calculate materiality for each individual component and communicate that materiality of the component to the component auditor. Okay, compute materiality for the group as a whole and compute materiality for each component and communicate to the component auditor. And based on this materiality, auditor needs to determine whether a particular component is material to the consolidated financial statements or not. Use materiality to determine whether components of financial statements are material to the group or not, and assess appropriateness of consolidation adjustments. Okay, the management, they will perform consolidation adjustments, right? Whether those consolidation adjustments have been done properly or not, that has to be reviewed. And finally, obtain confirmations from component auditor, like with respect to independence, code of ethics, etc., whether component auditor is following the requirements of code of ethics, whether he is acting independently or not. With respect to this, you have to obtain confirmation from the component auditor. Next, planning the audit of consolidated financial statements. For the purpose of planning audit of consolidated financial statements, you have to first of all understand the group structure. Group structure means how the companies have been holding. There will be holding company at the top, and how many subsidiaries this holding company is having, and how many further subsidiaries each of the subsidiary is having. Okay, this is known as group structure. So you have to first of all understand the group structure of the company for the purpose of conducting the audit of consolidated financial statements. And you should also understand the accounting policies that are being used, and based on that, determine nature, timing, extent of your audit procedures. And if in case, not if in case, mostly if you are doing audit of consolidated financial statements, you will have to use the work of other auditor, because if a company is having many components, then it is quite obvious that those components will be audited by some other auditors. So for purpose of auditing consolidated financial statements, you will have to use the work that has been performed, the audit report that has been issued by other auditor. So determine the extent of use of work of the other auditor, and you need to coordinate the work that has to be performed. Next, procedures to assess completeness of components to be consolidated. Now, it is responsibility of the management to identify the components, that is, how many subsidiaries are there, how many associates are there, and whether they have been properly included in the consolidated financial statements or not. This has to be identified by the management. Now, how auditor will check whether management has identified all the components, or whether there are any components that have been missed by the management. For this, what audit procedures auditor will perform? First of all, auditor will go through previous year's workings to see whether all the components that have been included in consolidated financial statements in the previous year are also included in the current year also or not. If any of the component is missing, auditor will inquire the reasons why those components are missing, whether the shareholding of the company in that component has reduced because of that, it has been removed from consolidated financial statements. What is the reason? Okay, that reason auditor will inquire. So first thing that the auditor will do is review prior year working papers for known components. Next, auditor will review parents procedures for identifying the components. As I have told you, it is a responsibility of the parent entity to identify the components. Now, in order to identify the components, what procedures the management is using, whether they are maintaining any register, or are they following any other procedure for the purpose of identifying the components. So you need to understand the procedure that is being followed by the management, and you should also conduct inquiries of the management to identify new components. Okay, you need to discuss with the management the transactions that has taken place during the year, the businesses that have been conducted during the year. Based on those discussions, you need to identify whether there are any new components that have arisen during the period, and review investment account of the parent entity and components to find out shareholding in other entities. in the books of accounts, you need to review the investment account of the parent entity and other components to identify whether any new investments have been made, and because of those investments whether any of the company has become the subsidiary or associate of the parent entity. And you should also go through the statutory records of the entity and review joint ventures, joint arrangements and other arrangements that have been entered by the group during the year, and identify changes in the shareholding during the year. So all these procedures you will perform in order to determine whether all the components have been included into the consolidated financial statements or any of the components have been missed. Next, consolidation adjustments. As I have already told you, these consolidation adjustments, they will be of two types. One is permanent consolidation adjustments and another one is current period consolidation adjustments. These permanent consolidation adjustments will make only in one occasion. Okay, permanent consolidation adjustments, they are made only on first occasion, that is at the time of acquisition of the subsidiary or the associate, or subsequently in any occasion when there is any change in the shareholding pattern in the subsidiary. Only in these in these two occasions we will make permanent consolidation adjustments. Now what are these permanent consolidation adjustments? There are two permanent consolidation adjustment. One is determination of goodwill or capital reserve. When goodwill will arise, when the purchase consideration is more than the value of the asset that you are going to acquire, then goodwill will arise. If purchase consideration is less, then capital reserve will arise. This is the first consolidation adjustment, which is goodwill or capital reserve. Second permanent consolidation adjustment is determination of equity attributable to minority shareholders or the non-controlling interest, you will call as per Ind AS. As per accounting standards, you will call it as equity attributable to minority, and as per Ind AS you call it as a NCI, non-controlling interest. So determination of minority equity shareholders or non-controlling interest, you will do this only at the single time, that is at the time of acquisition of the subsidiary. Or in case, if in future if at all there is any change in the shareholding, at that time you will determine this non-controlling interest, but you will not calculate non-controlling interest each and every year. So these adjustments, they are called, in the same way goodwill and capital reserve also you will not calculate them each and every year while preparing consolidated financial statements. You will just calculate this goodwill or capital reserve only at the time of purchase. That's it. Okay, so these are known as permanent consolidation adjustments. Now with respect to these permanent consolidation adjustments, auditor needs to verify determination of pre-acquisition reserves. Okay, whether pre-acquisition reserves and post-acquisition reserves has been bifurcated properly or not. On which basis this bifurcation will be done? It will be done based on date of acquisition, whether this date of acquisition has been properly determined or not, because based on this only pre-acquisition reserves and post-acquisition reserves will be bifurcated. This pre-acquisition reserves, why it is necessary to bifurcate pre-acquisition and post-acquisition reserves? For the purpose of calculating goodwill or capital reserve, you will include this pre-acquisition reserves. Okay, and also these pre-acquisition reserves, you will bifurcate them between the parent entity, that is the person who is acquiring, and the minority shareholders. So whether such allocation of pre-acquisition reserves between parent and minority has been done properly or not, this will have impact on determining the value of minority shareholders. So whether this uh, allocation of pre-acquisition reserves has been done properly or not, you need to verify, and verify changes in these items due to change in the shareholding. In future, if at all there is any change in the shareholding, then these capital reserve, this goodwill, this minority shareholding, they will also change. So accordingly you need to calculate these values again. So those are permanent consolidation adjustments. Moving to current period consolidation adjustments. In the current period consolidation adjustments, you will mostly find intercompany transactions. Okay, elimination of intergroup interest paid, intergroup management fee paid, etc. Okay, these kind of intergroup expenses you will eliminate. If any amount of interest is paid by holding company to the subsidiary company, then holding company it will book as interest expense, subsidiary company it will book as interest income. At the time of consolidating, why to show them again? You can just eliminate that expenditure portion and income portion. So such eliminations they will be done each and every year. So they are current period consolidation adjustments. Next, unrealized intra-group profit on asset transfer. Let's say during the year, parent company has sold an asset worth 1 crore rupees at a value of 2 crores to the subsidiary. Now, in the parent's financial statements, 1 crore should be showing as profit on sale of asset. In the standalone financial statements it is okay, but when you consolidated both parent and the subsidiaries financial statements, then this amount of profit of 1 crore it becomes unrealized profit, because asset it is just transferred to our subsidiary only. And in the consolidated financial statements, what is the use of showing that unrealized 1 crore rupees of profit? So you need to eliminate that unrealized profits on asset transfers within the group. Next, intra-group indebtedness. If at all there is any intra-group indebtedness that has been occurred during the year, you need to eliminate them. Adjustment related to harmonizing different accounting policy. If the parent is following a different accounting policy and a subsidiary is following a different accounting policy, for the purpose of preparation of consolidated financial statements, you need to harmonize these accounting policies. So this harmonization of accounting policies it will also be done each and every year while preparing consolidated financial statements. So we call it as current period consolidation adjustments. Next, adjustments for subsequent events. This is subsequent events. Now, first of all, subsequent events are those events that occur between balance sheet date 31st March of particular year and that is balance sheet date and audit report date. Okay, so first of all, these subsequent events they needs to be adjusted. This is one type of adjustment that this point is talking about. There will also be another type of subsequent event adjustment. What is that? Now, let's say subsidiary is preparing its financial statements till 31st December 2023. Okay, this is the date and as on which balance sheet is being prepared. Okay, subsidiary is following this uh, period, this financial year period. Okay, let's say subsidiary is some foreign subsidiary, so they are following calendar year as financial year. Now parent entity is Indian company, so it follows 31st March 2024 as balance sheet date. Now consolidated financial statements they needs to be prepared as on 31st March 2024, right? Now the adjustments with respect to events that occurred between 31st December 2023 and 31st March 2024 in the subsidiary must be made for the purpose of preparing the consolidated financial statements. Okay, even these adjustments should also be done for the purpose of preparing consolidated financial statements. And as usual, let's say the audit report on consolidated financial statements is being provided on some 5th May 2024, and further subsequent events till 5th May 2024 will also be considered. Okay, even these adjustments should also be made. If at all those are adjusting subsequent events that you need to adjust. And the subsequent events between 31st December 2023 and 31st March 2024 should also be adjusted for preparing consolidated financial statements. Even these type of adjustments they also become current period consolidation adjustments. Hope that is clear. So this first point, it is talking about this type of subsequent events, and the second point is talking about this type of subsequent event. Okay. Next, gap conversion. Gap means generally accepted accounting principles. If the subsidiary is a foreign subsidiary, then the financial statements of such foreign subsidiary would be prepared as per foreign gap. Now, if they have to be consolidated into the consolidated financial statements, they have to be converted to the Indian gap, that is our local gap. So such gap conversion adjustments, they'll also be made each and every year at the time of preparing consolidated financial statements. So they are current period consolidation adjustments. Next, determination of movement in equity attributable to minority interest over the periods. And finally, adjustments of deferred taxes. Since you have eliminated lot of intergroup transactions, certain deferred tax adjustments, deferred tax would have arisen. So those deferred tax adjustments should also be provided by you as part of current period consolidation adjustments. So these are 9 current period consolidation adjustments. Next, information to be disclosed in the consolidated financial statements. See, in the consolidated financial statements, you need to disclose amount of net assets belonging to each of the component and amount of net assets belonging to the parent, and also percentage of such consolidated net assets. Okay, you need to give name of the parent and the name of the subsidiaries, and you need to show how much net assets belong to each of the subsidiary and how much percentage of the total net assets belong to each of the subsidiary and the parent entity. Such presentation must be given in the consolidated financial statements. In the same way, the similar type of presentation should also be given for share in the profit and loss and share in other comprehensive income. Okay. Next, examples of disclosures that need not be made in consolidated financial statements. Now, in the notes to standalone financial statements, you will make certain disclosures, and in the notes to in the notes to the standalone financial statements of parent, and also in notes to financial statements of component, you will make certain disclosures. Whether all those disclosures which you have made in the respective standalone financial statements should also be made in the consolidated financial statements, the answer is no. So what are certain examples of some disclosures which should be made in the standalone financial statements but need not be made in the consolidated financial statements? What are such examples? Let's see. First of all, source of bonus shares issued. Now let's say during the year any of the component has issued a bonus share, or if the parent entity has issued a bonus share, then in its standalone financial statements it needs to disclose how bonus shares have been issued. Okay, whether from securities premium or reserves on surplus, what has been utilized for issuing these bonus shares, it needs to be disclosed in the standalone financial statements. But however, this disclosure, it need not be given in the consolidated financial statements. Hope that is clear. And disclosure of unutilized money. Let's say during the year subsidiary or any parent entity has raised amount through IPO or FPO. If there is any unutilized amount of that total proceeds that have been raised, then you need to disclose that amount of unutilized money in the notes of that standalone financial statements. But however, such disclosure, it is not required in the consolidated financial statements. In the same way, disclosure under MSME Act, okay, Micro Small and Medium Enterprise Development Act. As per this act, there are various disclosures that need to be given. The basic disclosure is the creditors. You need to bifurcate the creditors into two types. One is normal creditors and creditors falling under MSME. Okay, because the MSME, if you have taken credit from any of the MSMEs, there will be a time limit. Within 15 days, you need to repay that credit. So, okay, like this, there are various disclosures that needs to be given as per MSME Act. these disclosures, they are applicable only for standalone financial statements. Okay, the disclosures as per MSME Act, they need not be given in the consolidated financial statements. Hope that is clear. Next, disclosure of investment. Now let's say parent entity has made various investments, then it needs to give statement of investment wherein the name of the company in which it has invested and the type of securities that it has invested in, whether it is equity shares, preference shares, debentures, and what is the amount that has been invested, what is the percentage of shareholding that it is having. Like this, a complete list of investment must be disclosed in the standalone financial statements. But however, such a disclosure of investment, it need not be given in the consolidated financial statements. And also value of imported raw materials, value of imported consumables, and value of imported capital goods should be disclosed in the standalone financial statement by comparing value of indigenously purchased raw material, indigenously purchased capital goods, indigenously purchased consumables. That means here basically you are telling of the total raw material that the company has used, how much raw material you have imported and how much raw material you have sourced locally within India, how much capital goods you have imported, how much capital goods you have sourced locally in India. Such comparison needs to be given in the standalone financial statements. This comparison, however, not required in the consolidated financial statements. Hope that is clear. That is the fifth point. Next, expenditure that the company has incurred in foreign currency in the form of royalty, know-how, interest, dividend, any other professional expenditure. Okay, this expenditures that have been incurred by the company in foreign currency should be disclosed in the standalone financial statements. However, such disclosure, it need not be given in the consolidated financial statements. And in the same way, the amount of income that the company has earned in foreign currency by way of export of goods, by way of royalty income, know-how income, professional income or consultancy fee, by way of interest and dividend and other income. Okay, of the total foreign currency that the company has earned during the year, the four bifurcations needs to be presented. Okay, in each of the segment, how much foreign currency the company has earned. Hope that is clear. So these are some of the examples of the disclosures that has to be given in the standalone financial statements but need not be given in the consolidated financial statements. Next, you should obtain written representation from the management that all the components that the management knows have been included for the preparation of consolidated financial statements, and management has identified all the reportable segments for the purpose of segment reporting in the consolidated financial statements. With respect to this, a written representation from the management has to be obtained, and in the same way management has identified all the related party transactions for the purpose of disclosure in the consolidated financial statements. With respect to this, a written representation you need to obtain from the management, and appropriateness and completeness of permanent and current period consolidation adjustment. Okay, you need to obtain a written representation from the management that all the current period and permanent consolidation adjustments that have been made are appropriate. Okay, with respect to these four aspects you need to obtain written representation. Next, reporting. Just a second, I will change the view of this reporting. So yes guys, I have just made this single reporting chart available separately so that you know you'll be able to see it clearly. Now in this reporting there are five scenarios. In each of these five scenarios, how the auditor has to report, let us see. First of all, if the parent's auditor is also components auditor, okay, the auditor of parent company is also the auditor of subsidiaries. That means he has audited both the financial statements and he is also auditing consolidated financial statements. In that situation, he needs to verify whether consolidated financial statements have been prepared as per applicable financial reporting framework or not. If at all there are any deviations in the consolidated financial statements, with respect to applicable financial reporting framework, then you need to consider what impact it will have on your opinion as per SA 705. Consider the impact of deviation on opinion as per SA 705, and you need to issue audit report on consolidated financial statement stating whether consolidated balance sheet, consolidated P&L, consolidated cash flow statements are showing true and fair view or not. This is a reporting responsibility if parent auditor is also the auditor of the components. Next scenario, if parent auditor is not the auditor of components, in that situation the parent auditor needs to utilize the work that has been performed by the other auditors. So he needs to consider the requirement of SA 600 using the work of another auditor, and in his audit report he needs to indicate portion of financial statements audited by such other auditors. How he can indicate portion of financial statements audited by such other auditor? He can specify the percentage of assets that have been audited by other auditors, percentage of revenue that has been audited by other auditors, percentage of cash flows audited by other auditors. Okay, percentage or amount of cash flows or revenue or assets that have been audited by other auditors, which have been considered by the parent auditor in his audit report. This he can specify, and such reference by parent auditor should not be considered as a qualified opinion. Okay, now the parent auditor in his audit report he is referring the work that has been done by other auditor. This reference should not be considered that the parent auditor is modifying his opinion on the consolidated financial statements. No, it should not be considered as a modification. Okay, this is not a modification, he is just referring the work of other auditor. That is a second scenario when parent auditor is not the auditor of component. Next, different accounting framework. If parents financial statements have been prepared as per a particular accounting framework and components financial statements have been prepared as per another accounting framework, in that situation there are two options available. First option is management of the parent entity, it needs to perform adjustments for conversion of the components financial statements from that financial reporting framework to the financial reporting framework that is being followed by the parent, and those conversion adjustments have to be audited by the auditor. That is the first option. See, parents management shall convert components financial statements to framework that is followed by the parent, and auditor shall audit those conversion adjustments. That is the first option. Second option is alternatively component itself can prepare its financial statements as per the financial reporting framework that is being followed by the parent entity, and that local auditor of the component he will audit those financial statements that have been prepared as per the financial reporting framework followed by the parent entity, and that audit report will be sent to the parent auditor. Now the parent auditor will use that audit report. Okay, see, alternatively, component itself can prepare financial statements on the basis of parents accounting framework, and local component auditor issue audit report on above financial statements, which will be used by the parent auditor. Next, different auditing framework. In the previous scenario, we have seen what will be the reporting requirement if different accounting framework has been used. Now, for the purpose of auditing, okay, there are auditing standards, right? Different auditing standards have been used. The components financial statements have been audited by component auditor by following the auditing standards of foreign jurisdiction. Let's say that company is a foreign company, so that auditor has audited those financial statements as per the auditing standards that are applicable in that foreign country. Now, whether that audit report can be used by the parent auditor for the purpose of consolidated financial statements, the answer is no. Okay, the audit of subsidiary company, whether it is a foreign company also, it has to be done as per the Indian auditing standards. Okay, those auditing framework that is acceptable in India, and only that audit report can be used by the parent auditor. Next, components are not at all audited. If components are not audited, auditor of consolidated financial statement shall consider what will be the impact on his opinion on the consolidated financial statements as per SA 705. Okay, so this is the reporting requirement. By this we have completed Audit of Consolidated Financial Statements. And here we'll also be having a discussion with respect to SA 600 that I will be revising you in another video. Okay, I'll be winding up this video as of now. Take care. Bye bye. See you. And if you want to purchase our classes, you can visit our website lecturepedia.in and you can place your order. Okay, take care. Bye bye. See you.